Everyone invests differently. Some people chase excitement and fast results. Others prefer stability and long-term growth. Some panic when markets drop, while others see opportunity in volatility. Here's the truth most people don't realize. Investing success isn't about being smart or lucky. It's about understanding your own behavior. Two people can invest in the same asset at the same time and end up with completely different results. The difference is how they react to gains, losses, and uncertainty. Most investors fail not because they chose the wrong stock, but because they chose a strategy they couldn't follow. Today we'll explore 7 types of investors, helping you understand your habits and the approach that fits you best. There is no perfect investing strategy. Every approach has strengths and weaknesses, depending on the person who uses it. The biggest mistake investors make is copying what works for someone else without considering their own tolerance for risk. A strategy that looks perfect on paper can fail if it causes fear, stress, or impatience. Your investor type depends on 3 things. How much risk can you tolerate? How long can you stay invested? How do you emotionally respond to losses? Understanding your type makes investing simpler. You stop fighting yourself. You stick to your plan, and you're more likely to see consistent results, even during turbulent markets. The conservative investor prioritizes safety above all else. Their main goal isn't to get rich quickly. It's to protect what they have. They invest in low-risk assets like bonds, dividend-paying stocks, and index funds. Volatility makes them uncomfortable, so they focus on steady growth over time. Their strength is discipline. They stay invested during market crashes because their portfolios are designed for stability. Their weakness is missed opportunities. They may underperform during strong bull markets. For conservative investors, peace of mind is a key return. Slow, steady, predictable growth is more important than headlines or hype. Conservative investing works best for people with shorter time horizons or who rely on their portfolio for stability. Retirees and cautious savers often fit this profile. The main danger is comparing yourself to aggressive investors during bull markets. Seeing others earn faster returns can trigger regret or impulsive decisions. Successful conservative investors avoid that trap. They focus on long-term security, steady compounding, and emotional peace. They accept that slow growth is normal and that missing the occasional boom is part of the strategy. Discipline is the real key. Consistency beats chasing hype. Growth investors focus on the future potential of companies. They invest in industries expected to expand, like technology, healthcare, or emerging markets. Short-term price swings don't scare them because they prioritize long-term gains. Volatility is the cost of growth, and they accept it willingly. Their advantage is upside potential, but the risk is emotional. When expectations aren't met, losses feel personal. Successful growth investors are patient, disciplined, and understand that market noise is temporary. They focus on company fundamentals, long-term trends, and compounding returns over time. Growth investing tests patience and confidence. Prices can fluctuate dramatically, often without warning. Bad news can trigger fear, while temporary gains may cause overconfidence. Some investors abandon growth strategies at the worst possible moment, just before recovery. Others continue adding positions gradually, letting time work in their favor. Emotional control is the difference between success and failure. Growth investors learn to ignore short-term swings, trust their research, and stay committed to the long-term story. The goal isn't to avoid all losses. It's to make decisions you can stick with over time. Income investors focus on regular cash flow instead of capital gains. Their portfolios are built around dividend stocks, rental income, bonds, and interest-bearing assets. This approach appeals to those who want predictable, steady income, regardless of market fluctuations. Knowing when money arrives helps them plan expenses and avoid stress. The strategy may seem boring compared to high-growth investing, but reliability is the priority. For many, consistent income outweighs headline-grabbing returns. Patience and consistency are key. Income investors understand that slow, steady accumulation of wealth often beats sporadic gains from speculation. The strength of income investing is stability. Regular cash flow reduces emotional stress and provides financial security. The trade-off is slower growth. During bull markets, income-focused portfolios often underperform high-growth strategies. Successful income investors accept this and plan accordingly. They focus on long-term reliability, not short-term excitement. Over time, this approach can fund lifestyles, support financial independence, and withstand market downturns. It's not glamorous, but it's effective. For those who value security over volatility, income investing is ideal. Speculative investors chase high-risk, high-reward opportunities. They are drawn to assets with explosive upside potential. Cryptocurrencies, options, penny stocks, and short-term trades. For them, excitement is part of the strategy. They enjoy the thrill of markets moving rapidly and the possibility of turning a small investment into a life-changing gain. But speculation carries the highest emotional and financial risk. A single misstep can erase months or years of gains. To succeed, speculative investors need strict risk management, position sizing, and a plan for losses. They must also control emotions. Greed and fear can destroy portfolios quickly. Successful speculators balance opportunity with discipline, while those who lack patience or rules often fail. Speculation can create massive gains, but it can also lead to devastating losses. Many beginners underestimate volatility and overestimate their ability to time the market perfectly. A few lucky wins can give false confidence, prompting larger and riskier bets. Successful speculative investors limit risk on every trade, accept losses quickly, and avoid chasing returns emotionally. They stick to their rules no matter what. Unsuccessful investors, on the other hand, often double down on losses or abandon discipline entirely. The key takeaway? Speculation is not investing for the faint-hearted. It can work, but only for those who combine knowledge, discipline, and emotional control. Value investors look for companies undervalued by the market. They buy when sentiment is low and prices are below intrinsic worth. They believe markets overreact in both directions. Fear pushes prices down, optimism pushes them up. Value investors exploit these extremes by buying low and holding until the market recognizes true value. This style requires patience, discipline, and independent thinking. It can feel slow and boring, especially during market rallies, but it rewards those who resist short-term pressures. Successful value investors understand that time is their ally, and short-term volatility is not a threat, but an opportunity. Value investing requires patience. Prices may stay flat for months or years, testing investors' resolve. The risk is emotional. Seeing other stocks soar can trigger doubt. But the core principle is simple. Buy undervalued companies and wait for the market to recognize their true worth. This waiting period rewards discipline. Those who stay invested often enjoy outsized gains once sentiment shifts. Value investors embrace the slow journey, knowing that long-term consistency beats short-term excitement. In the end, value investing is about staying rational, ignoring noise, and trusting the fundamentals. Socially responsible investors want their money aligned with their values. They invest in companies that care about the environment, ethical leadership, and social responsibility. Their portfolios include sustainable businesses, ESG-focused funds, and companies committed to fair practices. The challenge is balancing impact with performance. Not every ethical company performs financially, and not every profitable company meets ethical standards. Successful, socially responsible investors diversify, research thoroughly, and aim to grow wealth while creating positive change. For them, investing is as much personal as it is financial. Socially responsible investing is growing because investors are realizing profit and purpose can coexist. Companies that manage environmental, social, and governance risks often outperform over the long term. This approach encourages patience, research, and a focus on sustainability. Investors learn to avoid hype and focus on companies with strong long-term fundamentals. Over time, socially responsible portfolios can match or even outperform traditional ones, while also making a positive impact on society. Passive investors don't try to beat the market. They buy broad index funds or ETFs and hold them for decades. They trust time, consistency, and diversification over active trading. Instead of reacting to headlines, they stay invested through ups and downs. The key advantage is simplicity: low fees, broad exposure, and minimal emotional interference. Passive investors rely on the power of compounding. They know that trying to time the market or chase trends often leads to underperformance. Patience and discipline are their greatest allies. Most active investors underperform due to overtrading. Passive investors avoid this by doing less, not more. They ride the market's long-term growth, using time as their advantage. Even during short-term declines, they stay the course. Patience is rewarded with consistent compounding, while costs and emotional errors are minimized. The simplicity of passive investing makes it a favorite for beginners and seasoned investors alike. It removes the stress of picking winners, yet produces reliable long-term results. To discover your investor type, ask yourself, how do I react to losses? How long can I stay invested? What matters most? Growth, income, or purpose? Your answers reveal your natural investing style. Understanding it allows you to select strategies you can stick with instead of copying others blindly. Many successful investors combine strategies. A single portfolio may include conservative, growth, income, or socially responsible elements, depending on goals and risk tolerance. This balance allows for stability, growth, and income, while reducing emotional stress. The key is understanding which combination matches your personality. Consistency beats chasing trends or copying others. By combining strategies wisely, you can build a resilient portfolio that grows steadily and aligns with your values. The biggest mistake isn't picking the wrong strategy. It's picking a strategy you cannot follow consistently. Markets will test patience, discipline, and emotional control. Investors who succeed are those who stay committed, even during downturns. Consistency beats brilliance every time. A well-chosen, stick-to-able strategy will outperform the smartest but inconsistent investor over decades. Remember, slow, steady, disciplined investing often wins the race over risky, impulsive decisions. Stick with your plan, adapt cautiously, and let time do the work. If this video helped you understand your investing style, like it, subscribe, and share it with friends. Comment below. Which investor type do you identify with? Are you conservative, growth-oriented, income-focused, speculative, value-minded, socially responsible, or passive? Understanding yourself is the first step to long-term investing success. Knowing your style helps you avoid mistakes, reduce stress, and stick to strategies that work for you.